Hi, it's Helen Tarrant.
The main thing is that I want to actually take you guys through this presentation on commercial property growth and yield, because the market is changing a lot at the moment, and most of the time what we're seeing is a compression in terms of the yield. So we want to know what happens in this market if it changes. So and Greg and Stephen and myself, we've both done separate presentation to put this together. So I'm going to show you some examples of properties and what happens in commercial property growth. And then Stephen and Greg will take you through their part of the presentation, and then show you now during our presentation that our upcoming group deal, what it would be like if things changed, the metrics changed. So without much ado, I will share my screen. And let's slideshow. All right, so tonight I'm actually talking about commercial property growth. So how to analyze it. So there's a myth in this industry that people say, okay, there is a no growth in commercial property. Now, that's absolutely not true, because if you're in the property space, there is capital growth in almost every kind of property. It's just depending on where you buy, the type of property that you bought, the area. It also has different types of capital growth. And of course, we know that one of the things about capital growth is that it's not something that you can predict. We don't have a crystal ball. We can't say, okay, in X many years, this will be what it is. We can look at the history and say, look, property doubles itself between every 7 to 10 years. Where does it happen in commercial? Yes, but sometimes properties can be 12 years. Sometimes property can be 5 years. Sometimes the property can be 16 years. So it really, really depends. But one of the things I want to show you is how we analyze commercial property growth. And when we put that to a few scenarios, you start to see that even though you may have a property that's underperforming in a hot market, even if you have to renegotiate rent, in a hot market, as the yield compresses, you actually retain the value of your property. So I will do this little bit of a presentation on it. So this is the concept, and this is the example how it works. Greg is going to talk a little bit about what happens if you had a property that been affected by COVID, because as you know, some of you know that Greg has done a lot of work on for property management, and one of the big things that through COVID is property management and how you manage the tenants and what's happened. And sometimes things happen as a result of COVID and some tenants go bust. So does that really devalue your property? And then finally, Steve is going to apply all of this into what we're doing in our current deal. So, so let's get started. Ooh. Okay, so commercial property. Go back. Commercial property growth is based on these four things. So your current market yield, or we call cap rate. So what's happening in that current market. Second, it's about rental growth. So is the rental growth that's happening naturally as part of your lease. Increased rent. So does the rent increase because there's more demand in the market? And then just generally demand for actually that type of asset in the market. So there's four ways for commercial property growth. And when we look at current market yields and cap rates, one of the things that we look at is the area. So regional versus a metro area. So in a regional area, there's certain parts of regional areas that doesn't compress as fast compared to metro areas. The type of tenant. So the type of tenant really matters because the yield changes. So if you want a medical tenant, you are actually going to be paying, you're getting a lot less return. So in somewhere like a Sydney or or Melbourne, you could get as low as 2 or 3% if it's in a key location. If it's a medical in, say, a regional area, it could be a 6%. So the gap could be anywhere from 3 to 4%, sometimes even up to 10%, depending on the location. So for example, if you're buying in a mining town compared to someone that's metro, a professional type tenant or trade tenant. There's a class of tenants. So do you have a brand name tenant, which means do you have a McDonald's, KFC, Subway? Do you have a national tenant? So a tenant that is not a brand name, but a tenant that has a national chain that is local to Australia. So maybe any of the gym franchises or some of the local suppliers of childcare, but they only just happen to be sort of not your brand name operators, but your mum and dad operators, and they happen to have 3 or 4 of those. ASX listed companies, so they can be somewhere like an NRMA, or they can be a dental clinic, a tenant who's been listed on the stock exchange. And also then the class of assets, so a warehouse, a retail, or an office space. So the type of asset within commercial property space. So all of that affects the cap rate. So for example, you wanted to buy in a metro, you want to buy medical, and you want to buy brand name type tenant, and you wanted to buy a property that is a warehouse or type tenant. Say like you've chosen all of those. If that's the case, then you are probably going to be looking at somewhere between 2 to 4% in terms of the cap rate and yield on that property. Now, if that changes and you're looking at a regional area and you want a medical type tenant still in regional, but you still want your brand name and you still want a warehouse property, that may change that to now a 6% yielding property. So that all, of course, depends on the location. Now, if you say you want to buy metro, but all of a sudden you don't want to buy medical and you want to buy a professional type tenant, so you might have an accounting, a law firm, or a professional service of some sort with a different, let's say they're not a brand name, they're national tenants, then you're thinking, well, I can buy an office space. Well, all of a sudden now we might be looking at 6%, and in regional areas we might be looking at 8% because they're not the favorite of the month. So yields and cap rates change independently depending on what are the criteria. So that's why everyone's strategy is so individual. And that's why when I do the strategy session, some people think, oh, it's just straight out, I want these things, let's go and find that property. Well, there is a yield usually to match that, and it matches into the area. And as the market changes and compresses, that also changes as well. So we've seen for the first time in a decade that Townsville, in the space of, let's say, 9 months, has gone from an 8.5% town to now a 7.5% town. So they've compressed by 1%. We've seen Brisbane compress for probably more than 1%, probably now heading towards 1.5% in terms of their compression in the last 12 months. So and so there's more secure. So you really, what are you balancing out is your security versus the risk, and you're balancing out your cash flow versus the growth as well on this point. So rental growth is pretty much as simple as sound, because it's really rental growth that's built already into your lease. So most leases have a rental growth, annual increases, so that's CPI, so that's consumer price index for your local area. So if you buy somewhere in Queensland, it will be pegged to Brisbane. Buy somewhere in New South Wales, pegged to Sydney. Somewhere in Victoria, pegged to Melbourne. So fixed annual ones can be 2%, 3%, 4%, or 6%, depending on what kind of tenant you have and how much you contribute to them. That fixed annual increases might be there. Market increases. So you come to a time where there is a rent review, or at least when you take the tenants taking the option, and the market increases because there's changes in the rent, or for that particular type of tenant, they're paying premium as well. And then there's also turnover rent, which really happens in shopping centres at the moment. So it doesn't really apply to you, but more to shopping centres. So rental increase, or increased rent, is very different from rental increase. So they're two actually separate things. So increased rent actually talks about the market as a whole. So if in the market there is a lot of demand. So let's say a little while ago, before COVID hit, we had huge demand of properties in the metro office space area. Everyone wanted to be on Pitt Street. Everybody wanted to be in the CBD of Sydney. And that was where all the headquarters would be. That was where the prestigious law firms were. That was all the prestigious, you wanted to be someone that takes you seriously. You want to be in the metro area, the city area. So people paying exorbitant amount of rent. So they were pushing the rents up because the demand was so much. And there was literally getting no vacancies in the city. Now, obviously, that's changed because of COVID. There's new negotiations on rent. There's downward pressure on rent. And downward pressure on rent at the moment is happening all across the board. It doesn't matter if you have metro Sydney or Brisbane or Melbourne compared to regional. In fact, you would have less downward pressure on rent if you're in regional compared to metro, because at the moment, because of how the pandemic has hit, it's affected more metro areas than regional, which also has now caused the compression in yield in the regional areas. So rental growth is where there's demand. So more demand leads to increase in rent, but on a per square meter rate. So instead of saying paying $200 a square meter, you might now pay $250 a square meter. And lack of confidence, which is what we're experiencing at the moment, leads to more incentives. So you might have to give your tenant an extra month rent free or a cheaper rent. So instead of $200 a square meter, they might be paying $100 or $150 a square meter. So in the market where rental are growing, so does the value of your property. So I want to use this example. At $500,000 round numbers, so $500,000, say you buy 7% net yielding property, it's $35,000 in net rent. Now, when you go to re-tenant or when you go to market and you do a market appraisal, just like you would do in residential, do a market appraisal, and the agent says, look, there's a 5% increase in the rent. So the rent is going up by 5%. Now that on $35,000 is $1,750. So not a huge increase in the scope of things. If you look at it on a monthly basis, it's, about $150 a month. So, works out to be about $40 a week or something like that. So it's not a huge amount of increase for the tenant, but how that flows through to you is that instead of getting $35,000, you're now getting $36,750. Remember, your mortgage is exactly the same, so that $1,750 goes straight into your pocket. But let's say the market hasn't changed and the yield stays the same as 7%, so the return stays the same as 7%. Now, because you've had the increase in rent, that automatically increases the capital value of your property. So that flows through to $25,000. Now, if you look at $25,000 against $500,000, you'll realize that is actually a 5% growth on your property. So what that rental increases actually mean for you is that a rental increase is directly related to the capital growth of your property. So if you're looking at the return now for your property, you should be looking at it's 7% in cash and 5% on the back end, which is the capital growth. So the whole ROI on this property without leverage is 12%. Now, when you're looking at leverage, it's going to be a little bit more. And so, I need to go back. Oops, yeah. So that's what increased rent is. So now we're up to the part about demand in the market, which is our fourth point. So demand in the market depends on what's popular for that moment and class in time of assets. Now, 2 years ago, most people want to have a retail or an office space in Sydney Metro because you will never go vacant in a property like that. It's never going to be an issue. They can never see the rents continue to go up, very little vacancies. It's very secure. Now, that's been switched around. Most people now want a warehouse industrial type property. But look, in 3 or 5 years' time, the office spaces will come back, the retail spaces will come back, and that will get that would actually get a capital growth jump as compared to warehouses, which will go sideways for a few years. So, I mean, that's just markets, it goes in the loop. Well, you have we have a property clock in terms of the residential side. In commercial, you have more of that demand and supply because it's very market driven. So, for example, at the moment, most people prefer to buy industrial warehouse type properties. Therefore, the yields are much lower for industrial. So let's say the same area. Let's say you want to buy in Brisbane. And you want to buy an office space in comparison to a warehouse space. Office space is going to give you 1% more than warehouses. Warehouses are going to sit at 6%, or sometimes now warehouses are listing at 5.5% in Brisbane. And the office spaces are listing at 7%. Yeah. So 2 years ago, that was the other way around. It meant that office spaces were commanding 4%. And now if you're looking at office spaces, some office spaces can get up to 6% in metro and up to 8% in regional. So if you're looking for cash flow and you are buying property with a professional tenant, there's no reason why you shouldn't go with an office space as opposed to a warehouse space, because it's all about longevity of hold and building out diversity. You can always buy a warehouse property when they no longer become the hot property, and therefore you get a better return. If you buy it now, you're going to be waiting quite a few years to be able to get the value back on that. But you will get some cash flow. So that is the demand in the market. And now finally, when we put all of those things together, we talk about what's important about yield compression. Now, when I talk about yield compression, I look at how we work in residential space. So in the residential space, it seems like in the last 3 to 4 months, in a blink of an eye, some properties have gone up in value by 20 to 30% in certain areas, and the vendors literally did nothing. They lived in the house went up by 30%, they sold it, that was it. Now, that's purely in the commercial space. That's what we call yield compression. In the residential space, that's just capital growth. And so the two of them are very similarly linked. So what that actually means is that, look, rents, if you look at residential, hasn't really changed. So for example, you're renting a property and it's $1 million property and you're renting it for, and let's say $1 million buys you a 2-bedroom place in Sydney, and you're renting that out for $600 a week. Well, it's still going to be $600 now. In fact, the downward pressure on rent probably makes it $550, but let's say $600 a week. Now, the property could go up from $1 million to $1.2 million, but the $600 still stays per week. So the person who's buying in at $1.2 million is actually getting a lesser return for their investment. And the reason they can accept that is that they're banking on the back end capital growth. And you do similarly the same thing in commercial. So as yield happens, which is what's happening in this market, it's a hot market like it is now. So one of the ways to combat that market is to get in quick. One of the things is to be decisive with your decisions. If you can put it to contract ASAP, you want to be doing that. And for all of you who actually bought commercial property before, really even now, and even if you're buying now, you're already making money in the market. Anyone who bought 12 months ago already made capital gains, whether they're regional or in metro. Anyone who's even buying now for the next 12 to 18 months will continue to make capital growth on the back end. So that's actually really important to know, because at the moment, because of the yield compression happening so fast, there is actually a really good chance, if you are doing any kind of property uplift, you are actually going to receive massive capital gains at the back end. So right now we're seeing 5% in Sydney and Melbourne. We're seeing 6% in Brisbane. Traditionally we're seeing 7% in Brisbane, but now that's compressed to 6, and things are listing at 5.5 at the moment. So they're getting close to Sydney, and then Sydney was going to come back a little bit to about a 4% in the future. So yield compression happens when there's too much demand but not enough stock. So what's really happening is that every time a property is listed, there's properties being sold sight unseen within 48 hours, and people are just buying them regardless. So look, because they're chasing cash. And the question is, why are they chasing cash? Well, in this market where you have volatility in the stock market, you have term deposits or cash in the bank being less than 1%, and you have residential going a bit crazy, but the returns are very mediocre. And for most people, they ran out of servicing. Well, commercial seems the most logical space to put things. Especially if you understand property and you're in the property space. So that's what's driven a lot of that demand. Also, because of how COVID has changed the way the different states behave, a lot of people have stopped investing in Victoria for the moment, and they've shifted that into Queensland. So it made Queensland super hot and made the yield compression really fast. So how does that work in real life? So for example, you buy a $500,000 property, and originally you're getting 7% yield. So that was the example we were using before. That's a net rent of $35,000. So the net rent hasn't changed from what we were previously working on. Now, if the market changed, let's say your rent stayed the same and you had no actual growth in rent. And that happens if you bought in areas in regional. So let's say there's no growth in rent. But the market has changed, and the cap rate or the yield has decreased from 7% to 6.5%. So that's only a 0.5 percentage change, which we've seen already in the last 12 months. Then your property is now worth $538,000. So that's $35,000 divided by 6.5% times 100, $538,000. So what does that equate to? That equates to 7.6% growth in your property. So you're getting a 7% cash plus a 7.6% growth in your property. Unleveraged, that is a 14.6% ROI, return on your money. So you've got to look at that because where else could you get that 14%? And this is why the market is so hot. So I want to show you some examples. So these are examples of properties from our portfolio. So Wodonga, for most people know, that's regional Victoria. It's on the border of Albury and Wodonga, so New South Wales and Victoria border. So we bought this in 2014 for $975,000. At that time in Wodonga, the cap rate was, or the net yield was 9%. We bought at that time, the tenant was paying $90,000 at purchase. Sorry, there's a typo. $90,000 at purchase. So they were paying that net rent. Now, over the 5 years we've had it, so the tenants had a 5-year lease and then with 5-year options. So in the 5 years we had it till 2019, the rent has gone up each year by CPI, so Consumer Price Index, so let's just call it 2%. But then when it came to market rent, we actually renegotiated and actually brought the rent back to its original place because there was just downward pressure on rent, and we weren't negotiating at that time. And now currently the rent still sits at $90,000. So the rent hasn't changed between 2014 and 2021. So in that 7 years, the rent hasn't changed. But mind you, interest rates has changed dramatically. In 2014, interest rates was between 5 to 6%. 2012, it was between 6 to 6.5%. So interest rates have changed dramatically because at the moment they sit about 3%. So $90,000. But what has changed is that there was a 2% compression in the market. So 2014, the yield was at 9%. 2021 today, some properties are listed at 6.5% yield in Albury. So I put Wodonga at the moment 7%. That 7% will sell that property tomorrow, sight unseen, to someone who will buy that property for $1.285 million within 48 hours, because that's how hot the market is. In fact, there's very little listings of quality stock because we have Rico, which is a international tenant, so a branded name tenant. We have them on a 5-year lease, so people are paying a premium, and we can probably even push that to about a 6% in this current market. So that probably puts us at someone at 1.35 million. But we bought this property at $975,000 in 2014. So in that time, the property's actually gone up about $300,000. And it's given us cash flow, but it's gone up by $300,000 purely because of market change. Nothing to do with the rental, nothing to do with the rent. We didn't get an increase in the rent, but the market changed. So we got an extra $300,000. Now, if you look at that, and now that's been almost 7 years, that $300,000 divided over that 7 years, about 30 odd grand a year. So it's probably somewhere around that, maybe a 3% growth. So the total return on this property is probably a 3% on the 9% is a 12% return on investment. So, but this is a classic example of properties in some regional areas that don't grow in rent over time, but they definitely still grow in value. So you can have, so those markets and capital growth in commercial property can happen one without the other. And finally, the trifecta is what happens when you have a property in an area where you're getting a solid tenant, but you also get tenant on the longer lease, plus you've got the income, plus you have the capital growth. So that makes the double whammy, and it makes a property basically triple. So this is the first property that got me addicted to commercial property. This is, for most of you who've ever been on my seminars, you know about this property. This is our commercial property that I first bought. North Sydney, $360,000, bought in 2012, my first ever commercial property. At the time, it was $31,000 in net rent. This is the original flyer that I dug up of the actual property. It was a 5-year lease. It was a space of about 50 odd square meters in there, and it was a Japanese restaurant. For me, this was a gamble because I've never actually done a commercial property deal before. And back then, the interest rate was 6%. And so that was like, we were making a margin, but we're still making the margin you would make today if you bought into Sydney at 5.5%, because today the interest rate is at 3%. So obviously, as the interest rate lowers, you'll find that the yield lowers as well, so that it's all in comparison. You're still clearing the same margin. So this was the investment. And over time, so we've had this property for 9 years now, so 2012, 2021, and in August, it would be officially 9 years. The yield now in this market for this type of property is probably around that 5% mark, or sub 5%, because it's in Metro, it's in North Sydney, it's in a hub, so it's probably going to be worth more than that. But I took the 5.5% because that was just a conservative value. 5.5% will sell this property tomorrow. The current rent has also grown each year, so from 31,000 is now 53,000. So it's grown about 80% over that time. And that's from rental increases. Yes, we had to give the tenant rent relief during COVID, but the tenants has actually never really missed a day of rent in their life. Even though we gave them COVID relief, when they came back, they started paying rent. Now, that's a very old photo. This is a photo from the original flyer of what this restaurant looks like. In fact, I actually don't know what the restaurant looks like inside because I haven't been there for probably 7 years. But it doesn't mean the tenants have stopped paying rent. They continue to pay rent. There's never been any issues with this property. It continues. They've had a change of owner, and the new owner continue to pay rent. Sorry, I added my N on the wrong place. So this is where it starts to become really exciting, because you've got a property in Metro, the yield has compressed, the rent has gone up, it has almost tripled itself. So what does that mean on that return? It means that, we bought in at 8.5, but over time it's gone from 360,000 to 976,000, or, it's probably even higher. So the property itself has done, it's got over $600,000 of growth. So it's done something like 180% of growth on that property. So when you look at that, that is well over the double digits. I can't even work out what that is, but that's well over the double digits in terms of return on that property. And that's telling you about holding in longevity. This growth didn't happen in 2012 to 2014. Nothing happened because the GFC hit. So for a long time, the property was stagnant. There was no capital growth. But then from 2014 to 2016, we had a little bit of growth. But from since then to now, we've had stellar growth each year upon each year. So capital growth is not linear. You'll get some growth, you'll get some down, you'll get some ups, but it is all sometimes an arbitrary value that only works when you cash in on it. But it is something we definitely do need to take into account when we're looking at the back end of a property. And there's some just general rules of thumb that I work with, and this is just from my experience of working in the commercial space, is that if you're in regional, it's probably somewhere at the moment, somewhere between a 2 to 5% in terms of growth. If you're in a metro, it's somewhere between a 4 to 8% in terms of growth. That's just an average of that. And of course, somewhere like North Sydney have done way more than that. Somewhere like Wodonga falls within that realm of that. Now, total ROI, this is really, really important because it applies to every single deal we do with our groups, every single deal that we do with our clients. Every strategy that we talk to our clients about, we talk about ROI. So it's not just about the cash, because if you chase too much cash and don't have any growth, you're not going to end up with much in the pot for when you need to refinance and get the next property. Now, if you have too much growth but not enough money in the pot, you still can't refinance to move forward. So when you're really evaluating a commercial property or a deal of any sort, you need to look at the total ROI, or return on investment, which includes both the capital growth, capital growth and the cash flow. So the cash flow and capital growth is what you need to look at. For example, 7% cash is what we talked about, with a property yielding at 7%, plus a 5% growth on the back end because the market has changed, equals 12% return on your property. So basically on your investment. If the yield compression happens and you own the property, so by then, let's say you bought a property and the yield starts to compress in the next 12 months, then the ROI in your property starts to increase even more. So they say the next year you get a 10% increase. Then the ROI starts to be, then you're starting to look at 7% plus 10%. and that becomes 17%. And that's what makes it so attractive for people to do uplift projects, for people to actually do projects that have, you know, a vacancy in it, or a project with things that are under rented, or projects with tenants that are vacant. So in some sense, in this current market, I actually prefer a property that you can uplift over a property that has below market rent, because there's downward pressure on rent. So therefore, if you have a normal standalone tenant, so like especially a retail tenant or an office tenant, because they're not the flavor of the month, try to renegotiate rent with them will be really, really hard. Whereas you have a property with an uplift potential, you can clean it up, put a brand new tenant in there, and because the market is compressing, you can actually get that return in the back end. So moving forward, Greg is going to share with you a property that is vacant. Look, a lot of this information is very, very sensitive, so he's not going to share with you the location of this, where it is in Sydney Metro, but he's not. But it is some of the examples is we're working with through this COVID period, and Stephen's going to show you how our group deal works by applying this formula as well. So that our group deal is that Eagle Farm self-storage, where we're creating an uplift. So there's a cash component and there is an uplift as well. So